Last year, your savings earned you $95. Your bank earned about $900 on the very same money. You did nothing wrong. That's exactly why it works. $25,000, 1 year, two very different numbers. One is printed on your statement. The other is never shown. Economists call that gap the spread you never see. The only question is how big yours is. So let's count it. Here are 5 numbers. Together, they turn a safe savings account into a quiet, almost guaranteed loss. We'll climb them one at a time. What you're paid, what the money earns, the scale of it, what inflation takes, and the one number that ends the whole thing. Start with what they pay you. This is the number on Mike's statement. He keeps $25,000 in savings, an emergency fund he built carefully over years, doing everything he was told to do. His bank pays the national average rate, 0.38%. Run the math on $25,000. A full year of interest comes to $95. 95, not a month, a year. And Mike is one of the lucky ones. At the country's largest banks, the average savings rate is 0.01%. On the same balance, that pays $2.50 for the year. That's the first number, what you're paid. It's the spread you never see, measured from your side of the glass. Now the other side. When Mike's money lands in that account, the bank does not let it sit. It lends it out as somebody's mortgage, somebody's car loan, somebody's credit card balance, at rates many times what Mike is paid. And if the bank would rather not lend at all, there's an easier option. It parks the cash at the Federal Reserve overnight, risk-free. As of June, the Fed pays banks between 3.5% and 3.75% to do exactly that. No borrower, no risk. Apply that to Mike's $25,000, and the money earns about $900 a year on the risk-free option alone. Across the whole industry, the gap between what banks earn on their assets and what they pay on deposits has a formal name: net interest margin. The latest figure reported to the FDIC is 3.31%. That margin is the engine. Your deposit is the fuel. So look at the two sides of the same $25,000. Mike's side, $95. The earning side, around $900. Same money, same year. One number is printed on his statement. The other is never shown. That is the spread you never see. Mike is one account. Now multiply. There are hundreds of millions of deposit accounts in America, and most of them pay close to nothing. Stack that spread across the entire banking system, and here is where it lands. In the first 3 months of this year alone, FDIC-insured banks reported $80.5 billion in profit in a single quarter. For the full year before, it was almost $300 billion. That profit is not built on a trick. It is built on a default setting. Millions of accounts, each leaking one small, unseen number every single day. Yours is one of them. Now the number that turns a bad deal into an actual loss. Inflation. Over the last 12 months, prices rose 4.2%. Mike's savings earned 0.38. Subtract one from the other. The real return on his emergency fund is negative 3.8%. Read that again. Not a small gain, a loss. His $25,000 sitting in a safe account will buy about $1,050 less by this time next year. The $95 of interest disappears before it covers even a tenth of what inflation quietly removes. This is the quiet part. The account is called savings. On paper, the balance never drops, but what it can buy shrinks every month you leave it there. That is the spread you never see finishing its work. So why does anyone leave money there? Here's the part that should bother you most. The escape costs nothing. The same money in a high-yield savings account, federally insured, the exact same FDIC protection, pays between 4 and 4.5% today. On Mike's $25,000, that's about $1,100 a year instead of $95. 11 times more for the same safety with a transfer that takes one afternoon. Which means the tax was never a law. Nobody forces Mike to accept $95. The system is simply built on the assumption that he won't move, that he'll stay where his paycheck already lands, out of habit, out of trust. The spread isn't hidden in fine print. It's hidden in your inertia. And inertia is the one thing the bank can count on. Go back to where we started. $25,000. $95 of interest. One line on a statement that looked, for years, like safety. Now you can see the whole number. The $95 you were paid. The $900 the money earned. The 4% inflation took. And the $1,100 that was always there, one transfer away. The bank never lied to Mike. Every figure was disclosed, buried in a rate sheet he never opened. He wasn't robbed. He just never checked the other side of his own money. The spread you never see only works as long as you never look. So look. That's the whole protocol.